Good afternoon, and a warm welcome to this XRB webinar on accounting for leases for Tier 1 and Tier 2 public benefit entities. If you are either a lessor or lessee for your building, motor vehicles, computers, photocopiers, even at below market rates, then the proposed arrangements may well affect you. So we thank you for registering and attending this important session. I'm David Barrow, XRB Comms and IT Manager, the moderator for this session. This afternoon we have Anthony Heffernan, Director of Accounting Standards here at the XRB. Anthony is our presenter, assisted by Amy Lu Huynh. This is a meaty topic, so we intend for the session to run till about 1:30 p.m, and there will be time for questions after Anthony's presentation. The slides should be displaying on your screen during the presentation. We will make a recording available to you after the webinar, as well as post the slides on our website. As attendees, you can also ask questions during the session. Amy will endeavour to answer them right away, but if it's a question all attendees would benefit from, Anthony may choose to answer at the end of the session. You can ask a question by typing it into the question pane, which is on your attendee control panel on your screen. You will have downloaded this control panel when you signed on to the session. Check it out now. Now it's lunchtime, so feel free to grab a coffee, eat and sit back and enjoy this session. Bear with us for just a few seconds while we change over the presenter.
Right, good afternoon everyone. Thank you David for that very warm welcome and setting us up for such an exciting session on an important topic of proposals to changes to how we account for leases, an IFRS proposal. It's fantastic to have just looking at my screen, over 100 people online at the moment and still climbing, people coming in, people have grabbed a bite to eat and getting themselves settled in. So that's fantastic to be talking to so many people. And really one of our main objectives of providing this webinar is, and I'm going to keep repeating it as we go through, to get your feedback on these proposals. It's vital that we hear from you of how you feel about these proposals and if they'll work in practice and if they'll provide benefits. So my name is Anthony Heffernan, Director of Accounting Standards at the New Zealand Accounting Standards Board. My role is to lead the accounting team that supports the NZASB. Who have primary responsibility for developing and issuing accounting standards in New Zealand. As David mentioned, today's webinar is on the proposed changes to accounting, proposed changes that will impact lessees and lessors. So that's probably quite important that it's impacting both sides. Now, the proposed changes we're discussing today will ultimately impact, as we work through the process, I'll comment further on it shortly, but it will ultimately impact Tier 1 and Tier 2 public benefit entities. And that means we're talking about public sector entities and also very important not-for-profits, the charities, the larger charities will be impacted in the future as these proposals work through. When I think about leases, just about every reporting entity has a lease arrangement of some description. That may be from vehicles, buildings, photocopiers is one that always comes up, phone systems, laptops, you name it. The key question that's always arisen for me over time, and it's probably based on my former life as an auditor, was always around that operating lease, finance lease distinction and having that debate around when is something operating, when is something financing, when you should be disclosing a lease on the balance sheet, when you shouldn't. All those things are coming to a head in this ED. Also, which is quite, well, more than interesting for us at the NZASB, and I suggest for you, is that the ED considers a number of different leases from a public sector perspective and a New Zealand not-for-profit perspective, and that's what we call concessionary leases. Leases at below market terms. A common term used in New Zealand is peppercorn leases. And sometimes, or very often, because there's no clear accounting requirements at the moment, the existence of those peppercorn leases or leases at below market terms are not reflected in the financial statements. You don't see the benefit of them. So many of those, there's many of them around, and many people might not realise how many they've got. I think is what's going to come out of this. We start to think of what we've heard people talk about as surf lifesaver clubs. They've got land and buildings that maybe been provided by local councils. Maybe they're getting rented $100. And you think about surf lifesaver clubs, they're sitting on beaches on $1 million locations. What is the fair value of that property? Much more than a $100 lease. Things like scout halls, community halls. Then we think about long-term leases of 99 years. There's all sorts of different things out there in the public sector that were not fully considered under the for-profit standards that need to be considered by the IFRS. I need to be careful with acronyms of new people online. There's acronyms everywhere in accounting standards. IFRS, International Public Sector Accounting Standards Board. And I'll talk about shortly while we're talking about an exposure draft issued by the IFRS. Just finally on my opening comments before we really get into it, just to maybe a little bit of a disclaimer. So the main objective of this webinar is to promote awareness of the proposals. Again, it's to encourage your feedback so the NZASB then can consider that. Important to note that the NZASB, New Zealand Accounting Standards Board, is not yet considered the exposure draft. There will be in the upcoming meetings, and we've got some very detailed issues papers coming up in the March meeting on that. So just highlighting that if we express any views, or if I express any views, they're not the views of the NZASB. It's still out for the jury, as they say, for them to work out or make decisions around where they lie. So I may share some personal views, sort of try my best not to, as an independent standard setter, but very hard not to have an opinion on these things. And also many of the views that are expressed in here are the views of the IFRS, the International Public Sector Accounting Standards Board, their rationale of why they made those proposals. So we'll be expressing them. Does that mean we agree with them? Does that mean we disagree with them? Again, we haven't made those decisions, but I'll share with you at least the IFRS's thinking behind their proposals. So just to make before we get into it, we've got some polling questions as we go, and really good just for me to know people are listening for a start, and then also to get feedback. But just two quick polling questions just about knowing your audience, where people are coming from. Let's load them up now. And it looks like you've got the first one on your screen that you're about to click, and just tell us what sector you're from. So it's useful to know the audience, and if we're getting a mixture, which people are clicking their buttons pretty quickly, which is fantastic, and we have got a mixture. We did put the other in at the last minute because I am curious about the other, and we've got a number of others also. And I thought maybe that might be some for-profits that are thinking about their leaseholds and how they're going to impact their not-for-profit clients, possibly. So I think we've got good enough response, and I'll open it up so everyone can see it. And then there we go. IT works, which is fantastic. We can see the results there. So thank you. That's an even balance. That's useful for me. So I'll be focused on all sectors as I talk. So just one more before I get really into the webinar. Just launch that. Okay. And just another one, because this ED, exposure draft, definitely covers both sides, but it is useful to know where people are coming from. So is your interest mainly as a leasee? You rent a building from a leaseor and you're paying rent, or from a leaseor, you're making an asset available for someone else to use? Yep, I'll just about bring it up. Not too many surprises here. This is what we see in practice. Okay, so yep, you've got that on screen. The majority of people are leasees, which is fantastic. So there's some definitely changes there, and leaseors. I will still be covering both in the webinar. We will have some general practitioners, and possibly when we get to talking about concessionary leases, you may realise you are a leaseor and you didn't realise. So we'll cover both, but yeah, maybe a bit more focus on the leasee side. Okay, so let's keep moving. Okay, session outline, what's coming up ahead of you? How do we propose to outline this webinar? So I'm going to introduce the ED, the exposure draft. Then we'll outline the main proposals. So definitely it's not my intention at all to run through the whole exposure draft and all the detail. It's not a technical training session. It's to highlight the main changes from maybe what I call the status quo, IFRS 13, what you do now, what are the main differences. So we have got a new model for leasees proposed, a new model for leaseors, and also we'll make sure we get into the concessionary leases because some very interesting proposals there. And an area that the IFRS really struggled on, to be honest. That was a hard area, and developing new public sector specific requirements. So we'll get an understanding of what's going on there. Then I'll explain exactly how to provide feedback, so that's quite important, and time at the end for questions, comments. Before we do that, I'll just touch very briefly, just to recap on who we are. So we're the XRB, the New Zealand Accounting Standards Board is a sub-board of the XRB. XRB is a crown entity responsible for developing and issuing accounting and auditing standards. So I'm here representing, really talking about the NZASB today, talking about an accounting standard. Right, here we go. Just waiting for the slides to click over. Again, just touching on briefly of the development of PBE standards, and this is really to answer the question, why are we talking about an IFRS exposure draft, and how does that fit into the New Zealand environment, and what is the process for that turning into a PBE accounting standards? So the answer is why we're talking about it as exposure draft issued by the IFRS is that our PBE standards that are applicable for our public sector and not-for-profits are based predominantly on IFRS standards. We start with them. So IFRSs are issued by the IFRS, so International Public Sector Accounting Standards, are issued by the IFRS, and they're developed primarily for the public sector, then just given away in the name, International Public Sector Accounting Standards. And we look at that and work out if we need to make any more amendments to make them appropriate for our not-for-profits. But often that's adding additional guidance of how to apply the principles from a not-for-profit perspective. When the IFRS issues a consultation paper, we seek feedback in New Zealand, and I've got an extra box around that about seeking feedback around the importance of that. And the message is that once the IFRS issues a standard following an exposure draft, and then we in New Zealand consider how we're going to incorporate that into our New Zealand standards, it's really difficult to head off on a different road from an international standard. So we really need that New Zealand feedback now as that international standard is being developed. We do issue it again as a New Zealand exposure draft after the IFRS has completed their standard, and we develop our own domestic standard. But we really need that feedback now on the principles, the core approaches, because puts us in a very difficult situation if we get the comments after the international standards is issued. So that feedback now is vitally important. So just finishing off the order of events of developing a PBE standard, yes, the IFRS will issue a final standard, and then we'll consider that in New Zealand and develop our domestic PBE standard. But again, the key message is that it's predominantly based on the IFRS standard. I've just got this slide here that's about to click over. Decent delay, but we're there. And again, the message I just want to provide here is the amount of influence we've got in New Zealand on the IFRS and International Board. We have a member on that board, And we have a significant amount of influence coming out of the fact that in New Zealand we've adopted IFRS standards for the whole of our public sector and for our not-for-profits. So as an adopter, as a user, that means we come to that board with a huge amount of experience. Our comments are extremely valid, and the board takes notice of what we say. So those comments that we receive from you that influences what we, the NZSB, feedback to the IFRS board are vitally important, and they do make an impact, absolutely. Okay, so this is some opening comments. So let's get into the ED. So introductions, we start pretty high level, then we'll get into the detail, and even then if things aren't still making sense, we've got some examples which I hope will bring the proposals more into light of what the actual impacts will be. So ED 64 leases exposure draft issued in March, comment period, issued in January, and with a comment period of 5 months, started in March 2017. And the two main objectives or two main drivers, why did they start this project? Why are they introducing change? Some of you may be sitting there saying there's nothing wrong with leasing accounting at the moment, so why cause all this drama? The two main drivers are IFRS 16, and if anyone's been following the developments in the for-profit world of standards issued by the International Accounting Standards Board for for-profits, you'll know there's been significant changes there introduced by IFRS 16. A new standard's been issued and effective from 1 January 2019. So we've got a new standard in the for-profit world. With introducing significant changes, and so that means the IFRS that develops standards specifically for the public sector have to say, okay, well, we've got changes here for for-profits. What does that mean for our public sector? Should we also introduce the same changes? Or is there public sector specific reasons why we should do something different? And that is the key focus of the board's discussions. Should we follow IFRS or should we do something different? And are there other issues that should be considered from a public sector perspective? So that's the two main drivers. So that in mind, just commenting briefly on IFRS 16. I've got one slide here, but we could talk about IFRS 16 quite nicely over 2 hours. But what was IFRS 16 trying to achieve? Why did they introduce changes? And that was to address criticisms around the distinction mainly around lease accounting, around the operating lease and the finance lease. Did it make sense that we had two approaches for different types of lease transactions? We were saying one's an operating lease, one's a finance lease. Or should we have the same approach for all types of leases? Does that make sense to have two different ones? The ISB worked through 2 exposure drafts. They worked through a discussion paper. It took them a long time to issue the standard. They had feedback from people, hundreds of comments letters, and they explored a number of different approaches, which again, if we had 2 hours, I could go through all the approaches and explain them to you, but we won't today. For those that are really interested in the detail and want to know more about IFRS 16, those proposals that have been considered before are being discussed at our upcoming NZASB meeting. So those board papers, when they're unavailable on our website, they will make for a good read for those really interested in the background. But again, the key message is that we've got changes in IFRS 16. Should those changes be also introduced from a public sector perspective? That was the key question asked by the IFRS. So as we work through the examples, I have compared IFRS 16 with ED 64, so you can see the differences. So the key proposals in ED 64, again, at a high level, ED 64 is proposing a single right of use model for both lessees and lessors. So explain shortly what right of use means, and examples will make even more sense. But the key message at the high level is that ED 64 removes the current financing operating lease distinction. You won't see that anymore in the proposals. Lessee accounting substantially converged with IFRS 16. So for lessees, what was introduced by the ISB for profits has been taken over into the ED for our public sector and not-for-profits. So no significant departures. They couldn't find a public sector reason to depart. But for leaseor accounting, very different answer. And for leaseor, they have come up with a different approach, and we'll talk about that. And new public sector specific requirements for concessionary leases. So here's just a snapshot. Again, we're at the high level of the differences between IFRS 16, a standard issue for for-profits, and what's been proposed for our public sector, AD 64. And you'll see there that the key difference is that yellow for leaseors, that in the exposure draft, the IPSASB have applied a right of use model to both leasees and leaseors. They were quite keen to go for what you might want to call a symmetrical approach. So leasee accounting is the same as leaseor accounting, but you just kind of put a mirror to it. That's different where the IFRS 16 ended up, where they retained the operating finance lease classification. So they have got a different approach for leasee and leaseor accounting. Okay, so heading into right of use model, a new term for many. What exactly do we mean by that? So this is the idea that when you enter into a lease arrangement, the lease contract is really a separate. You separate that out from the leased asset. So the lease asset stays by itself, and that gets recognised by the leaseor. So the leaseor retains control of the underlying asset and continues to recognise that on its balance sheet. The fact that they've provided that leased asset to another party to use over a lease period, maybe an asset's got a useful life of 7 years, and they provide a lease arrangement for 5 years. The fact that they've given someone else the service potential of that asset for 5 years doesn't result in the leaseor de-recognising the underlying asset. It stays on their balance sheet. And then the lease contract, the lease arrangement, gets treated separately. So the leaseor continues to recognise the underlying asset. They'll then recognise a lease receivable for the right to receive lease payments. So that will come onto the balance sheet, the receivable, to receive all those payments they expect to get over the lease term. So that could, in many cases, if you think about a lease contract for 10 years, that could be quite a large receivable. And they also recognise a liability on their balance sheet to say that they've got service potential, future performance obligations. They've got performance obligations to provide that asset to a leasee to make it available for use. So they'll have a liability. So really grossing up the balance sheet. When people look at it, you might say, well, you end up with two assets. That was a question that came up with the IPSASB. And then from the leasee perspective, we've got many leasees. Again, you might want to describe it as grossing up the balance sheet. You won't have operating leases anymore. You'll recognise the value of that lease contract, being your right to use a building or right to use a computer or right to use a vehicle over the lease period. And you'll recognise an asset, being the total amount of the payments you expect to make over the lease term. So you recognise, again, if you had a 10-year lease, potentially quite a large asset comes onto your balance sheet. And you'll also recognise a payable. So of course, you've got to pay for that lease contract over time. So that's the idea. Now, the definition of a lease hasn't changed significantly, so that's substantially the same, but there is some additional guidance in there of how to work out, have you got a lease contract or not. Just some good news when we're talking about scope is that these arrangements, requirements, as I get into the detail, is there are some exemptions, proposed exemptions for short-term leases, so less than a year for a leaseor, and for leasees, 2 exemptions, short-term again, and underlying asset is of low value. So if you've got a lease for a phone system, a laptop, that could potentially be low value. Of course, judgment there, materiality, what is low value? They're not going to give you amount. You'll have to apply judgment. And also out of scope, as this is where it does get a bit more technical, is leases of zero or nominal consideration. Yes, that's right, they're out of scope, but then it takes you back to the standard on non-exchange revenue, and effectively you've still got to recognise those zero or nominal consideration leases at fair value, kind of headline news, and then it does bring you back into the standard again. So when I talk about concessionary leases, also start to think about zero or nominal consideration being treated potentially the same way. So when I get back to concessionary leases, how to account for zero will become a bit clearer. But they're out of scope, the messages, but you go around in a few circles and you'll end up back in the ED again. Okay, so that's high level. Talked about a right of a use model, talked about the definition and the scope. Now let's get a bit more into it, and at least for me, I think about, to make sense of this all, I think about debits and credits, and also think about examples. Okay, so this is the leasee accounting approach. So I've got the current accounting there on the left, and ED64 on the right. So current accounting, you make the classification, is it an operating lease or is it a finance lease? And for operating lease, you don't recognise any assets or liabilities. You're only recognising effectively the lease payments when they occur, and you recognise the expense when you pay it. So you don't bring anything onto the balance sheet when you enter into a lease arrangement for operating leases. For finance leases, yes, you do. You recognise a lease asset, being that you've got substantial the risks and rewards of that asset that's being transferred. You've got a lease that maybe it's got a useful life of 7 years, and you've got access or the right to 6 years of that useful life. So you bring that onto your balance sheet. You've got substantially the risks and rewards of that, and you have a liability for your future lease payments. That's current accounting. ED64 no longer has that distinction. You've just got one approach for initial recognition, and that's a single right of use model. Being that you're going to recognise the value of that lease arrangement, being your right to use an asset over a period of time. So you recognise the value of that. Many people think of like that as an intangible asset. The SBSB have never called it an intangible asset, but it feels like it. Can't quite touch it, but it's the value of that contract. And also the lease liability, your obligation to make lease payments in the future. So you think about what you do now for an operating lease. It's all in the note disclosure. You have that note disclosure of that large commitment of that 10-year lease, and you say, I've got a commitment for 10 years to pay that lease, operating lease. You only have that kind of disclosure in your notes, that 10-year lease. But in this case, it's not in the notes. That what we call a commitment comes in as a liability. In some places, it could be quite a large liability for all those lease payments you expect to make. Then subsequent treatment. And I think in many of these approaches, sometimes the initial treatment, yeah, they make sense. Maybe you agree with bringing things onto the balance sheet, but it's important to think about what's the subsequent treatment, what's the subsequent impact on your profit and loss, and does that make sense? So on the left, again, we've got the operating lease, finance lease, how that's treated now. And the main one to think about, because many of you have got operating leases, is that you only recognise the expense as it's incurred. So it's all it is debit, credit, bank, money comes out, recognise an expense. Now, that sounds pretty easy. Maybe you might like that. But then ED64, what's that got? Complete change. The single right of use model, it's saying doesn't matter what type of lease you have, doesn't matter what level of risks and rewards have been transferred, we've got a single model, and you've got to recognise you've already recognised the liability. So when you make those payments, you're going to be decreasing the liability. You're going to recognise some interest, which again gets a bit interest expense. It's a bit technical, that one. That's because that initial liability recognised was discounted for the time value of money. The idea that $1 today is worth more than $1 tomorrow. So when we initially bought on that liability, it is a present value, it's a discounted amount. So that results in interest being recognised over time and bank coming out. So we haven't got a lease expense. Instead of a lease expense coming through, we've got depreciation, because initially we recognise that right of use asset, and we're going to depreciate that over the lease period, or another approach that's appropriate. Many people that are online that maybe get a bit more technical, they'll say, is it depreciation or is it amortization? Because the right of use asset is many things an intangible asset. Some people get thrown by that. To me, it's kind of the same thing. And in the IFRS B exposure draft, they refer to depreciation the whole way through it. I did a find and search the other day and they don't mention amortize. So that's why I've got depreciation. Okay, so that's leasee. Effectively, it's bringing things onto the balance sheet is the snapshot. An example, just to make that even clearer, is so we've got a 10-year lease. This example, thinking about operating leases, so it's a building, $100,000 per year, 10 years, classifies operating. For simplicity, I've got an interest expense of $10,000 there, and that's just to show you how the discounting works. You can get quite technical calculating that, but let's just say $10,000, easy. I'm going to apply the cost model. So the leaseor will apply the cost model. Oh, sorry, leasee. Leasee will apply the cost model for the right of use asset. Why I've got that there is, again, it gets very technical, but you could apply different models. If you want to revalue that right of use asset that you're bringing onto your balance sheet, yes, you can, because you're measuring it in accordance with the other standards on either intangible assets or property, plant, and equipment. So you've got those options. But again, simplicity, let's just say cost. So current accounting, this is what we're all used to. We do nothing at initial commencement of the lease, and we just recognise the lease payments. Recognise an expense as that money comes out of the bank, usually straight line basis, and we just have note disclosure. That's what we're used to now. So it's just those $100,000 expenses. So this is annual. But what happens under the right of use model? So hopefully this makes a bit more sense to people. What's been proposed here? So initial recognition, you sign a lease agreement. This is the first transaction on the left. So you've got a right of use asset, $900,000. So that's your $1 million discounted. So that's your value of your right to use the asset over the lease period. Comes onto the balance sheet as an asset. And you've also got a liability because you've got that asset, but you haven't paid for it yet. So you're going to pay those lease payments over time. Liability. So they match off. So some people might say that's just grossing up the balance sheet. Not too much to worry about. Then subsequent year accounting. What's our impact on our profit and loss? So we do have an interest expense, 10K, of the financing. We've got no lease expense as we're used to seeing, and instead we've just got the depreciation of straight line over the life of that right of use asset, so depreciation. Right, so I'll just pause there and I'll bring up the next poll. And we've been talking about this for a long time. Some of you may be thinking about this the first time, a lot to take in, but just a poll to get your initial reactions on the proposed model for leasee accounting. So here's the poll. Do you agree with the proposals? You like the idea of bringing all lease arrangements onto the balance sheet and having matching liability? No, you want to retain IFRS 13, which is the operating finance lease classification that we've got now. You don't see a need for a change. Or that final no is you consider the IFRS B should consider another approach, that you don't think we should retain the current one, but you don't agree with what's been proposed. So we're getting some interesting results, which I'll bring up momentarily. So that's probably enough. So I just want to keep things moving. So I'll just bring that up. The results on screen. So everyone can see that now. So that's I think that's really interesting, and a 73%. We've got a majority of yes supporting the proposals. That makes sense to people. So yeah, that's very useful and very interesting. So thank you. Right, so that was, sorry, I'll share my screen again. Okay, so we'll move into the model for leaseors, and maybe I'll move a little bit quicker because of the initial comments, initial feedback that most of you are leasees, but yeah, difficult to rush these things. Okay, so lots of words, but I'll summarize these slides. So the key message here is that the IFRS chose to depart from the IFRS 16 approach, and the approach developed by the IASB. So quite a brave move, going for a different approach from the International Accounting Standards Board. And I've listed down here the consideration of that and why they came up with a different approach, why they effectively decided they wanted to apply a right of use approach for leasees, and why they also wanted to apply a right of use approach for leaseors, while they thought that made sense to have the same approach for each, different sides. So really the question again is there a public sector reason to apply a different approach from what the for-profits are doing? So the IFRS considered that leases are in substance financing transactions, and therefore you should be recognising a receivable. You should be bringing that receivable onto the balance sheet. So what they're saying is they didn't agree with only having operating leases where you only expense it when it's incurred or when you pay it. They also felt extremely strong, and they made a decision quite early on that the underlying asset for a leaseor should remain on their balance sheet. So I quite often think about Housing New Zealand and their portfolio of assets, properties that they've got available to lease. From the IFRS perspective, they thought it was very important that an organisation such as Housing New Zealand should have on their balance sheet all those assets, which they've got, the IFRS felt, ownership rights over and responsibility for, that all those assets that they lease, but as the leaseor, they should, and they've got responsibility for them, they should remain on the balance sheet. So you can pick up the financial statements and see all those leased assets on the leaseor's balance sheet in their entire value. They also had concerns around consolidation and the idea that within the public sector you will have leasees and leaseors within the same group, so they should be applying the same approach. They should both be, from a consolidation perspective, they felt it made sense that they both be applying a right of use approach. So that was a key factor for them to reach a different preliminary view or different view in the exposure draft than the IASB. So that's some of the reasons in snapshot. On summary, there are others. So again, the accounting and how it looks. So the current accounting for a leaseor, and appreciate that we haven't got many leaseors online, so even for me, I had to go back and have a rethink about this. How do they account for it now? So they have the operating lease and finance lease distinction again, same as before, but maybe put a mirror to it. How does a leaseor account for that? Under a finance lease, they'll have a receivable, and well, yeah, the finance lease is the most important one of current accounting, that they'll recognise a receivable. They have right to get lease payments off a leasee over time when you enter into that contract. So they'll bring all that onto the balance sheet, the receivable for the entire contract. And then the important point is they credit the underlying asset. So the underlying asset, they'll reduce on the idea that they've given up the risks and rewards and the service potential of that asset. They've given that to someone else. Someone else is going to get the benefits of it. So they, under current accounting and IFRS 16, you reduce the asset. The leaseor reduces that asset. So they've only effectively got the part that they retain. So that's important, because when we look at ED 64, they came up with a very different approach. One, they removed the operating lease finance lease distinction, and two, under the right of use approach, they didn't credit the underlying asset. They said, no, we want to keep that underlying asset on the lease's books. We don't want to meddle with that. We're not going to change that. Instead, we're going to recognise the lease receivable, same as the other side, the left, sorry, and we're going to recognise the credit there. That's what the difference is. They're going to recognise a lease liability being unearned revenue. The idea that the leaseor's got a performance obligation, they've got an obligation to provide that asset available for use. So they should recognise that revenue over time. Effectively, that lease liabilities, as you unwind it, you're going to recognise revenue, leaseor recognise lease revenue over time as they fulfil those obligations to make the asset available for use. Very different conceptual approach than where the IFRS 16 ended up, where they had a derecognition approach, where if you're going to transfer an asset and you've given up substantial rights, then you should derecognise it. Subsequent treatment, what happens in our profit and loss is that you have a different treatment, different treatment mainly on that finance lease. So the operating lease is gone under ED 64, and a finance lease, you're going to be recognising, under finance lease, you only have the interest revenue, and you have no lease revenue recognised because any gain or loss is accounted for effectively on day one when you derecognise the asset for finance lease. But under ED 64, because we're not derecognising the asset, leaseor's not derecognising, we're recognising that lease revenue over time. So that's the key difference. Same example as before, moved through pretty quickly. This is a leaseor perspective. And just thinking about the current treatment, we're just recognising the lease revenue come in. When the leaseor receives that money, they'll recognise the revenue. It's all good, pretty easy for an operating lease. And then what's the subsequent treatment from ED 64? And there you can see on the right the lease interest income coming in, and also that lease revenue coming in over time compared to the current treatment on the left. Sorry, compared to, yeah, this is all ED 64, recognition at the start and subsequent year. So you can see the different accounting there for an operating lease. Okay, so appreciate I've gone through that pretty quickly. And many of us aren't thinking about leaseors. I'll just bring up the next poll just to get people's views on how they felt about that. It's coming through, yes, now. So apologies for the pause. IT eventually gets there. So do you agree with the IFRS's proposals to adopt a right-of-use approach for leaseor accounting? So when you think about this, does it make sense that a leaseor and a leasee is applying the same requirements? Maybe that could be useful for consolidation purposes. Maybe that makes a lot of sense. Or no, you can see the reasons and why IFRS 16 went in a different route and decided for leaseors to retain the operating finance lease classification. Or no, you really just think this requires more thinking. I'm not really sure about this. It's probably the one you'll select for the last no. And again, some interesting results coming through. So I'll show the screen. There we go. So we've got a majority again. And it probably shows the result of me going through it pretty quickly. But the idea, well, I'm only assuming, the idea of a leasee, a leaseor applying the same approach, many people consider that has some merit. What happened at the ISB level is when they try to propose a similar approach for for-profits, they got significant feedback from leaseors, concerns around the cost of implementing this approach, and also concerns or questions around what's wrong with the current approach. Is it really broken? Do we need to come up with something different? So it's going to be really interesting seeing what the international response is. That's, as a preliminary response, that's very useful. Thank you. Okay, I think we're doing quite well. Timing. Oh, sorry. I'll bring my screen back on. Okay, I think we're doing very well. We're up to concessionary leases. And I think this is an important area because now we're talking about things that is specific for the public sector and our not-for-profits. And it's an area that has not been considered by IFRS 16 or the ISB. So this is new ground, and that could be hard. But they've worked through and they've come up with some proposals. For me, thinking about this, I found it quite surprising, to be honest, that we didn't have requirements. And that's because I thought about the current requirements for donated assets. And you think about donated assets at the moment. If I donate a building to you and you take full ownership of that, I've got no ownership left. If I give that building to you and you take full control of that, at the moment, under current accounting requirements, you'll recognise that and you'll measure the fair value of that building and you'll recognise a donation, because that's what I've done. I've donated an asset to you. And that makes a lot of sense under the current IFRS standards and under a current framework of recognising non-exchange transactions, recognising the fair value of those non-exchange transactions, the benefits of assets that are donated to you. So then, at least from my perspective, I think about, well, what's conceptually the difference for concessionary leases? Is a lease that I transfer over to you at, let's say I give it to you for free, or maybe I give it to you for $1, maybe I give it to you for $100 when the fair value is actually $1,000. How is that conceptually different from donating an asset to you? It feels appropriate to me that if I'm going to recognise an asset on the books, fair value, why wouldn't I recognise a concessionary lease on the books? So really now, I'll probably underline, I'm really sharing my personal views. But I was somewhat surprised that we didn't have any current accounting for it now. And that's the key point. It's current accounting standards are silent. You don't recognise the value of concessionary leases on your balance sheet. You may, if you're good and you want to be transparent, put some note disclosure in. That'd be nice. But there's no current accounting requirements. So this is filling a hole, at least from my perspective. So concessionary leases, what are we talking about? We're talking about leases at below market terms. So maybe it's a building, the fair value of a building in the marketplace is $1,000 a week, but you're getting that use of that building for $100, or sometimes it can be $1 or no consideration at all. So that transaction from the IFRS perspective, when they thought about it, it includes an exchange transaction and a non-exchange transaction. And the exchange transaction, when they're talking about that, is what you've actually paid for the lease. What's the contractual lease payment that you've agreed to? And the non-exchange component is the difference between what that lease would be at market value and what you've paid for it. So again, if it's $1,000 in the marketplace and you're paying $100, you've got a non-exchange component of $900. Hopefully that math was right as I'm talking out loud. I think it was. So the concessionary leases, what's been proposed is to measure it at fair value. Again, same concept. You should bring a right of use asset onto your balance sheet to recognise you've entered into a lease agreement and you've got the right to use that building over a period of time. You'll bring that entire asset onto your balance sheet, the entire value of that right onto your balance sheet, and recognise that at fair value. If you're going to recognise that fair value, there's always could be another side of the transaction, and there'll be a credit to your profit and loss, what they call a subsidy. That's effectively the donation that someone's given to you. And that gets recognised in the profit and loss. Bit of judgment there, bit of interpretation, but it'll come on to, in many cases, it'll come onto your profit and loss day one, especially when you haven't got a performance obligation going forward. So if you haven't got an obligation to return that asset, if you don't use it for its intended purpose, then you definitely bring that subsidy on it at day one. It's going back to episode 23 when we talk about lumpy grants. do you recognise a lumpy grant on day one or over time? If you haven't got a return obligation, you have to recognise it on day one. Same kind of idea same kind of thought process around when you recognise that subsidy. Do you recognise the subsidy day one or over the lease period? So let's think about an example, just get away from the theory and see if we can bring this more to light. Debits, credits, what happens to our balance sheet, what happens to our profit and loss. So I've kept the same fact pattern. Market payments, leases 100,000, but the actual contractual payments that you've agreed to are 50,000. So you're getting a subsidy. You've got a concessionary lease. When you get technical, the discount is on the lease receivable, being the actual payments. So that's why we've got those following the different examples and maybe picking up the difference. That's why we've got 5,000, not 10,000. And we're going to assume that IFRS 23, it's the revenue from non-exchange revenue, requires the subsidy to recognise on day one, but you've got no present obligation. And you're going to depreciate that right of use asset over 10 years. So I'm not comparing to current accounting because we haven't got any requirements at the moment. So now which will be easier, we're just talking about what's the proposals under ED 64. So they've got the same right of use model, initial recognition. They say you should recognise that right of use asset on your balance sheet. And the key is that the proposal is you recognise that at fair value. So what's the market payments that you'd make in a market transaction, you discount that, and 900,000 is the fair value. Then you recognise the lease liability, and the lease liability is your actual contractual payments, what you're actually going to pay. And then finally, the difference is a subsidy, the non-exchange component being revenue. In this example, I've got it recognised on day one. But when you recognise that revenue, you need to go back through IFRS 23 and determine is it appropriate to recognise day one or over the lease period. Subsequent accounting, yes, we're going to reduce the liability for the actual payments. We've got a discounting and interest expense of 5,000. So first we account for the liability, just the contractual liability for actual payments. And then I think it's useful to highlight here the depreciation. So because you've bought a right of use asset onto your balance sheet at fair value, you've got a depreciation of 90,000. Depreciation you never recognised before. So depreciation is, again, is measured based on the fair value amount. So I'm just imagining maybe with some boards explaining what that depreciation is for an asset that you didn't pay for, or the one that you got as a subsidised amount. But that's the logic, that you recognise a right of use asset at fair value. You've got to, as you get the benefits of that asset, as you use it, you've got to depreciate it on a straight line basis. Okay, before I get into leaseors, I'll bring up the poll and just see what people are thinking about this from a leasee perspective, this idea. I'll bring it up. That was quick that time. Very good. So what are people thinking about this idea of you've got a concessionary lease, recognising it at fair value, and there is a cost to that, so it does require a bit of work. And we are getting feedback that there's a number of entities that could have large portfolios of these types of leases. So they've got to go through and somehow determine the fair value of them all. Does that cost outweigh the benefits? So I don't know if I'm not providing any views there. That's some of the questions. So it's a yes, no question. Do you think this is a good idea, or no, this is sounding a bit difficult and maybe I need to have a think, but we'll think about it. Now, just give it a bit more time because we're getting some interesting results. Okay, I'll bring it up. There we go. You have got a majority. I do remember when I did my CA exams, from memory, I think I needed 60% to pass. But yes, so it is rather balanced, and I did pass. So yes, 58%, no, yeah, 42, yeah, so there's people having a bit more think about that, and I think that reflects the mixed feedback that we received to date, that some people are thinking, or a number of people are thinking about the cost benefit and think about how difficult this would be. And other people's, yeah, they definitely see the merit in it, and they can see the principle, the argument for it, and it does make sense. So yeah, thank you for that. It's interesting. Okay, so now we'll head into the leaseor example, and this is where you get some really interesting results, and where the IFRS did struggle a little bit on coming up with an appropriate approach. At the end of the day, the IFRS have kind of already cemented themselves to the right of use approach. They've also cemented themselves to the underlying asset remaining on the leaseor's balance sheet. So when you get to concessionary leases, some of those decisions come back to impact and come up with interesting results. So here we've got a leaseor. They're providing a building available for use, 10 years, but they're providing it at a discounted amount, 50,000. So let's have a look at what impact that has when applying a right of use model and a fair value approach. So from a leaseor, they're making an asset available for use. They're transferring that asset across to someone else, and they can use it for a period of time during the lease. So right of use approach, they do need to recognise, bring that onto their balance sheet, the whole lease receivable. So you'll bring the lease receivable on at the contractual amounts, the amount of actual cash they expect to receive, discounted because you expect to get that over time. So you've got a lease receivable 450,000. You've got unearned revenue, and this is the sticking point, and this is where your head starts to hurt a bit more. And they put on the credit unearned revenue of 900,000. So that's the fair value amount. So they're saying they're going to get the benefit in the future of 900,000. And then the subsidy expense. And this initial recognition is all driven from the fact, again, as I said before, that they don't want to de-recognise the underlying assets. They can't change the underlying asset. So where does the credit go? That ends up being the 900,000. But they also wedded themselves very strongly to the idea that they wanted to recognise on the profit and loss for a leaseor the subsidy expense. It's the 450,000. So for many of us, and on the IFRS board also, the debit lease receivable, yep, that makes sense. The debit subsidy expense, I've given and I've made an asset available for use, but I've provided that a discounted amount or a subsidised amount. Okay, if I'm going to do that, that makes sense. I recognise an expense. Debit, cool. Oh, what do I do with the credit? And that's the sticking point, the credit. But in their wisdom at the moment, and it's exposed, it's unearned revenue. The other way other people would suggest it could have been done is that credit could have been the underlying asset. So you reduce the amount of the asset. But of course, as I said before, because they've made that decision that they want the underlying asset on the balance sheet, that credit couldn't be to the underlying asset. So it ended up being unearned revenue. So what happens in the subsequent year? And this again is where you get some interesting results and you think, does this work? So first, you have to account for the receivable. That's not too hard because we're just accounting for contractual amounts coming through. 50,000 comes through from a leasee, that's what they're paying. You reduce the lease receivable, it's at a discounted amount, so you've got an interest expense. Sorry, discounted. You've got a financing component based on the discount of the receivable. That's not too bad. Yep, I can get my head around that. But then the other sticking point we think, does this work? Probably one, conceptually, and more importantly, does it work practically, is that debit to unearned revenue and credit to lease revenue. So just have a think about your profit and loss under these debits and credits. The profit and loss of a leaseor will have a statement of financial performance with lease revenue of $90,000. that $90,000 is the fair value amount. So they receive lease payments of $50,000, but they're recognising revenue of $90,000. Does that make sense when a reader picks it up and they're recording revenue that effectively they're never gonna receive? They only receive the $50,000. Does that make sense? I'm trying very hard not to give an opinion at the moment, but there's definitely mixed views there, and it's a really difficult area. And to highlight why this, that the IFRS also considered this to be a difficult area, and there was mixed views, is that when you do work through the ED and the basis for conclusions, there was an alternative, effectively an alternative view expressed in the BCs, and that an alternative approach was just to recognise the leaseor transactions for a concessionary lease at the contractual amounts. So the contractual amounts, you're not uplifting for fair value. So you're just recognising a receivable of the $450,000, and you're just recognise unearned revenue of $450,000. So you wouldn't recognise the subsidy, and that's where the many FCSB members weren't comfortable. But then on the other side, you wouldn't recognise that uplift of revenue subsequently in your statement of financial performance. So to many people that made sense, that you just recognise your contractual balance, the amount of cash you're going to recognise. Because the different way of thinking about it is, if you, in your statement of financial performance, just recognise the 50,000 or discount amount, 45,000, that's already got embedded into it the fact that you provided it that at a discount at a loss. So why do you need to gross it up and show that subsidy expense separately? The other point that comes in out of this is quite a bit of potential volatility to the profit and loss. So again, think about on the left, recognition at commencement date. Potentially that subsidy expense that whole expense for the whole lease contract will get recognised on day one, $450,000. The whole amount hits your statement of financial performance day one. But then the other side, the revenue you expect to get, kind of to offset that almost, it gets recognised over time. So you've got a hit on day one of expense, but the revenue that you get will be recognised over the lease period. So that introduces quite a bit of volatility and potentially quite hard to tell the story of what's going on here to your users and to your boards. So I'll bring up the next poll and see what people think about that. Okay, some interesting results in there. It may be my fault. I felt like I was sharing some personal views there. So maybe underline there my personal views. So I'll go a little bit longer. Okay, I'll bring it up. Okay, so the results there, from my perspective, I think it highlights again our view at the moment that there's mixed views there. There is definitely some difficult areas. The subsequent accounting, the way it impacts statement of financial performance, gives some interesting results that for some may be hard to get our heads around. So there, yeah, from my perspective, taking this back to the NZASB, and it's already the conclusion we've got, is that we need to do some hard thinking here, and this is a significant issue that we will be working through at the NZASB and doing some thinking about, no question. So thank you for that feedback. Okay, so we're doing very well. I was wondering about timing, but we're right on track. It makes me think that I will go through anything too quickly. But from the responses, I think people are getting the idea, which is fantastic. And the whole purpose of today was to provide you with a high level. Of course, there's a lot of detail behind it. And to understand that, sorry, but you're going to have to read the whole exposure draft. So also in the ED, just to highlight, again, maybe that's the same point, is that there's other things in the exposure draft, but the key takeaway that I'd provide is that the other requirements, the other areas are not substantially different from current accounting, not substantially different from IFRS 16 issued by the ISB. But it has got sell and leaseback transactions. It's got some additional guidance in there of how to determine when you have got a sell and leaseback transaction. So that'll be useful because it can be a difficult area. It's got, of course, it's got the presentation disclosure requirements for lessees and lessors. It's got application guidance, quite a lot of application guidance on different examples on how to apply these different approaches under different circumstances, and that's extremely useful. I'm sure everyone's sitting there now thinking about the different types of arrangements they have and thinking, how's this going to work? So the application guidance, the additional examples is very useful. And the basis for conclusions, when you're thinking about how did they come up with these decisions, proposals, the basis for conclusions is extremely useful. And I haven't spent too much time today going through those bases. So for additional reading, that's there. And it's not a bad read, and you can at least get the understanding of what were they thinking, and then decide for yourself, do you agree? Okay, from my perspective, from NZASB's perspective, this is the most important section of the presentation, and we're just about coming to the end. How to provide feedback. It's absolutely vital that we receive feedback on these proposals so we can develop our New Zealand view and provide that back to the IFRS. The reason these are called generally accepted accounting practice is because these standards are not meant to be based on standards issued by standard setters. We do start by drafting them, and we have to consider the definition of assets and definition of liabilities. Standard setters, we talk a lot about conceptual frameworks and qualitative characteristics. That's our challenge to think about that. Of course, we need a framework of standard setters to base the development of these standards, but ultimately, standards are based on the feedback we get from you. And I can't stress that long enough. And all feedback and every feedback is considered, and it's taken to the international level. And they effectively, the IFRS has to, they've got the challenge of coming with a standard that's agreed to by the, generally agreed to. And if they get feedback to say you don't agree with these proposals, they will have to go back and rethink it. So the power is in your hands. If you don't agree with something, you need to let us know. So how to provide feedback. So what's coming up, and really important, because I do appreciate that I've rattled through this all pretty quickly, and we haven't had time, and of course we can't do it in a webinar, to really debate the different approaches and where things work and where things don't. So we are holding live in-person seminars, kind of a round table idea where we're really keen to get people discussing the different approaches, discussing where it works, where it doesn't work, and having those debates and having those really good discussions. So those seminars have been held in Wellington, Christchurch and Auckland, coming up. You can register on our website, and we absolutely encourage it. And it'd be fantastic to see everyone there and have a really good discussion. Because it's, from a webinar perspective, the main thing I can do is promote awareness of the exposure draft. So where to go on our website? So go to www.xrb.gov.nz, and this is our homepage, and go to the information hub at the top and events. And if you click through there, you'll go straight through to how to register for the upcoming seminars in the local cities. It'd be fantastic to see you there. How to respond to the exposure draft. So the exposure draft and all the information that goes with it. is on our website, and there is some additional information there issued by the IFRS, some summary documents to make it really easy to digest. So you go into our website and all those documents are available, and there you'll have the instructions of how to write submissions to us. The important message is that we're very happy to get informal and formal submissions. If you just want to write to us your views or concerns of how this could work or not work in practice, that'd be fantastic, and very happy to receive those just informal emails. Also, if you want to write a formal submission letter that we do get from many of the accounting firms, and we get from other from parties such as CANS, if they're online, I'm already putting pressure on them. That's fine too. We're very happy with those formal comment letters. So any feedback is good feedback, is the message. And the comments are due to us by 31 May. So that allows us to share all that feedback with our board, and that will be fed into our comment letter from the NZASB. And then also, if you want to write directly to the IFRS, which many New Zealand constituents do, you can do that. You can write to them directly, and they're due by 30 June 2018. So again, just to make it very where to find this. So go to our website homepage, and you get to the homepage, and you'll see there on the left bottom, Accounting Standards and Development. Go there, then you go to Documents Open for Comment. Click that, and then I have all the documents open for comment, and there's a few at the moment, but you'll see there the leases. If you click through there, you'll get all the instructions, you get all the information, you get full access to the exposure draft, full access to the summary documents. I would highly recommend reading the summary document issued by the IFRS called At a Glance. I should know the number of page numbers, but it's about 12 pages, and it's just a really easy read. And in some ways you can read that and you don't need to go to the exposure draft. But for those that like the detail, yep, you'll definitely want to jump into the exposure draft. The exposure draft is a draft standard that if we don't get feedback, or if the IFRS doesn't get feedback, will become a standard. Okay, so we've reached the end, 112, so I feel like I've done very well, as long as I've made some sense. So now that's the kind of the formal part of the webinar finished, but we're going to stay online and address as many questions as we can. So people that want to stay online and hear the questions, many will be applicable to everyone. I'm sure many will cover things that I've gone over too quickly. So yeah, if you want to stay online while we go through the questions, that'll be fantastic. Okay. So I'm just going to read them out loud, and just appreciate as I read them out loud, it'll be the first time I am also thinking about them. So I'll see if I can respond. So first one, if you have a not-for-profit as part of a group that is required to report in accordance with IFRS, then do you then adopt IFRS 16 for lessors also for the not-for-profit? Or do you have to prepare the not-for-profit under ED 64 PBE standards and then only change on consolidation? Okay, so I'll give this a go at answering the question. I might go off on a different tangent, but I think it will answer it. So group reporting, if you have a not-for-profit that's part of a group, it'd be quite unusual to have a not-for-profit part of a group where you've got a parent that's a for-profit. But the other way I'd think about it, which would be more common, is that you've got a not-for-profit group, a charity that may have a for-profit subsidiary, because you've set up that for-profit, maybe it's a company, you've set up a subsidiary for for-profit purposes, and then those profits are transferred back up into the parent, the charity. So in those circumstances, the subsidiary that's a for-profit, if they're preparing separate financial statements, of course of GAAP, they'll report in accordance with IFRS 16. And then when you consolidate, you'll have to make consolidation adjustments if there's differences between IFRS 16 and ED 64. So yeah, they'll be applicable if you're a lessor. So what I'm saying is that for a PBE group, you're a PBE parent, you have to apply the same accounting policies when you consolidate. So any differences between IFRS 16 and ED 64 would become consolidation adjustments. Okay, so from a lessor perspective, can you clarify how the original physical asset would be depreciated? So, yep, the lessor continues to recognise that underlying asset on its balance sheet and its full value, effectively its carrying value when it acquired that asset, and it'll continue to depreciate that asset in accordance with the property, plant and equipment standard. So it'll depreciate that over the entire, what it considers, and again, everything I say just appreciates me thinking out loud, so don't take everything gospel, but you'll depreciate that over the entire useful life of that asset. It won't be just the lease term, because you've got the entire asset on your balance sheet that is the value of the lease term and the residual value that you've got left when the lease is completed. So you continue to recognise, you'll determine the useful life of that asset. So it's not just the lease term that the lessor will depreciate. Again, that's not me jumping into a standard, so don't take it complete as gospel. Okay, next question. Should the 2,500 schools in New Zealand record the right of use land and buildings? And should the Ministry of Education not have land and buildings on its balance sheet? How do you account for capital improvements paid by the Ministry from time to time? Is this a donation expense? Oh, that's a loaded question. I think for a start, it's a really good question, and this is where it comes into the cost-benefit analysis of, does this make sense from a public sector perspective? When you think of the number of entities impacted and the number of potential lease arrangements out there. Yeah, I'm tempted to leave it there so I don't give the wrong answer, but more than happy for you to email us, and I might have a good answer with it once we've had a chance to think about it. There is a question about GST, and let's go back to when we used to do live presentations. GST always comes up, but it is hard to think out loud. In anything with GST, I think tax, and I think I'm not a tax expert, so I run away. So I won't answer the question on GST, other than to say I suspect that it shouldn't have any impact, but yeah, that comes with a fair amount of caution because I'm not a tax expert, so I'd better leave it there. Is this next question? Is this standard? Is this? I'll read it out. This has got it. Is this standard covers all leases, motor vehicles, cars? So the answer is yes. It covers all lease arrangements, and it's effectively bringing on the idea of applying a right of use model for all lease arrangements, except, and you get into the small print, those exceptions. Is it low value, or is it at least for a lease arrangement for less than a year? The ISB also had the same idea of a lease of a short term, but they worked pretty hard on making sure that people couldn't be clever and just set up leasing arrangements that maybe go for a year, then you renew it for a year, then it goes for another year. Tried pretty hard to make sure people couldn't be clever and get out of it. So it really does have to be for a year and then it ends. And that's all the questions. So we have got others, but they're the ones that we chose that may be useful for everyone to hear responses to. we'll have a look at the others, and more than happy for, if there's some pressing questions coming through, for you to email us. Please do that, and we'll come back to you. And your questions usually lead to areas that we should be thinking about more, so questions are good. So thank you. Thank you for everyone's attendance. It's been fantastic. It looks like we've kept everyone online, which is even better. So I do hope I've made some sense. I do encourage everyone to respond and provide submissions. And I respond even more for, if you can, to jump on our website, have a look at those seminars, and if you've got time to attend, because being able to discuss it in person is extremely valuable, and we encourage that. So thank you. I've enjoyed the presentation, hope you have, and enjoy the rest of your day.